Hello, everyone. My name is Weston Nakamura from Blockworks Macro in Tokyo. It's Monday, March 20th, 2023 at Asia Markets Close. Welcome to the Market Depth Podcast, bringing you global market commentary and analysis from the Asia Pacific trading session so that you know what happened overnight. So today, we'll cover the first market reaction out of Asia following the historic UBS takeover of Credit Suisse over the weekend. And by over the weekend, I mean hours before Asia market open on Monday. So, in a very rushed last minute deal, UBS will take over Credit Suisse with heavy support from Swiss authorities. So we have the government covering losses of up to 9 billion francs, and the Swiss National Bank, the central bank, offering 100 billion francs in liquidity. So this is an all-stock deal with a 1 to 22.5 share merger ratio. Okay, so about 3 billion francs for all shares of Credit Suisse, meaning the equity holders of CS got something, while a certain class of bondholders are wiped out. And so more on that in a moment. Right after that deal announcement, we also have an announcement out of the major central banks in a joint statement where dollar swap lines that between the Fed, the ECB, the Bank of Japan, the Bank of England, the Swiss National Bank, and the Bank of Canada, they'll be run from basically, the current weekly to now a daily basis. So these daily swap lines between the Fed, the ECB, the BOE, the SNB, BOJ, Bank of Canada, those are going to run at least until end of April. This is basically an existing facility that's addressing sort of a non-existent problem before it becomes a problem, in a way, right? So earlier today, we saw the Bank of Japan offer this, dollar fund supply operation and saw 0 bids. Okay, so again, there's no real need for it, but it's good to know that there is this, dollar supply facility in place now on a daily basis in case there's a need. Also, regarding central banks, we had the PBOC announce today that they've kept their 1 year and 5 year loan prime rate (LPR) rates both unchanged now for the 7th consecutive month. So 3.65% for 1 year LPR, 4.3% for 5 year LPR. These are, for those who don't know, these are kind of key lending rates. The 1 year LPR is a reference for like corporates. 5 years reference for mortgages, and just remember also that Friday evening we had an unexpected cut to the reserve requirement ratio, the RRR rate, by 25 basis points. That was the first time that happened since last year, December, out of the PBOC. Okay, so all of that occurred in central bank land. Now, as I just mentioned, one area of kind of maybe eyebrow raising amidst all this is in an area of what's called the AT1 bonds, also known as contingent convertible bonds or COCOs. So, about $17 billion in Credit Suisse's AT1 bonds got wiped out to zero, to worthless. Now, note that these AT1s were basically born out of the financial crisis, and they're supposed to perform this function of being buffers that are to take losses for bondholders if a bank's capital ratio falls too low. It allows for a bank to effectively prop up its balance sheet and stay afloat. These have been key sources of funding for European banks, and the total value of the European AT1 market is about $280 billion USD, $280 billion. Okay, so the fact that these AT1s, these Credit Suisse AT1s, got wiped out, it's not abnormal. As I said, they're supposed to do that in this scenario. But what's potentially controversial is that they were wiped out. However, equity holders were not completely wiped out. And so that violates this kind of standard capital structure of who gets paid out last, if at all, which are supposed to be the equity holders, right? In fact, Credit Suisse themselves also sort of reiterated this point about shareholders will, take hits before the AT1 holders. Just last week they said this. And so there are credit funds that took, long positions on CS, AT1s last week, essentially playing the long moral hazard game. And we're now looking at like minus 100% losses and are quite pissed off, as you might imagine. And who really cares about them, right? But the problem is, Now there's a broader question and kind of a scrambling of what these AT1s kind of across other institutions are valued at, right? Or even more problematic, just generally, broadly speaking, this questioning of or like the unknown of like what standard seniority of like capital structures are in such an environment, like when goalposts can be moved and have been moved in this way heading into Asia Open today. So let's just take a cross asset look at like the market reaction to all of that. So equity indices are down across the board from Asia market open, right? So Aussie SPY Nikkei were down, half 1.5% after cash open. Hang Seng in particular is down over 2.5% on the day, with every name on the index down, with the exception of Baidu, which continues its momentum higher from last week's like 15% surge after releasing its very own version of ChatGPT. But now, so that's what's happening in kind of like the equity index picture, but let's take a look at the rates picture now. Okay, so rates have also once again dropped sharply again today. 10-year U.S. Treasury yields, 3.5% were the highs, and below 3.3% were the lows for the Asia trading session. So basically a 20 basis point move for the 10-year Treasury, and then once again the 2-year yields making massive swing from above 4% to below 3.7% on the day. And then simultaneously, we once again see 10-year JGB yields sharply falling, right? Hitting as low as 20 basis points on the generic 10-year JGB. Once again, below that December yield curve control shock lift. It's below the 10-year JGB yield curve control band before the lift, which was at 25 basis points. And so that's once again continuing last week's trend of having the rates market being not only just overall on a downward sharp move, but exhibiting these very erratic moves in general, very, very volatile moves and sharp moves. And for those who listened to the last Friday's episode of Market Depth, you'll know that there's likely a structural problem here that's contributing to these sharp intraday movements in yields, and not necessarily like a demand for safety or collateral that explains the velocity of the moves themselves. So, on the back of both this like rates moves downward as well as a continued profit taking from like long positioning in bank shares, bank stocks should continue to see downside today, as they did during the Asia session, regardless of Credit Suisse and UBS's weekend activities. So it's difficult to parse out just how much of the CS UBS news is like impacting, if at all, and how much is just what would be the directional move in bank shares globally anyway. So one way to look at this is to look through like single stocks, particularly looking at HSBC and Standard Chartered, which are both listed and trade actively in Hong Kong. And they're both down heavily today during the Asia trading session. They're both down over 5% on volume, and both of which are also taking hits to their respective AT1 bonds. So it seems that while there is a broader macro-driven downside move to global mega-cap bank stocks, as per Topic's bank shares being down, there are also investors who are looking granularly at things like AT1 bonds and various other fundamental, exposures, and selling shares down as well. Very difficult to discern, but there are both of those factors, and that's going to be the kind of a difference between one class of bank stocks or one bank stock getting hit much more so than the other ones. So something that you could do potentially as a trade would be like a market neutral long short pair, in which you'd be long, Japan Topix banks as a basket against Eurostox banks, right? Because if you're getting downside to both, the Japan bank stocks will be hit less than the European ones because they have that additional sort of sell catalyst or sell force or momentum in play in the form of these sort of AT1 bonds. Either way, this looks like a setup for Eurostox banks to get hit pretty hard, and US banks stocks to get hit pretty hard as well at their respective opens. On the currency front, we actually don't see too much in price action across the major spot cross rates relative to the enormous moves that we've seen in sovereign rate space, which is another continuation of last week's trend. And FX shouldn't necessarily have to exhibit volatility just because the rates are. In fact, the fact that the major FX pairs are relatively stable amidst huge moves in sovereign rates indicates to me, at least, that yield spreads are more or less staying intact with one another, which therefore paints a picture of these rate swings that are just happening on a broad-based and correlated and almost indiscriminate manner, like they're mirroring one another, right? Such that the spreads between them actually don't change that much. And then one more thing to just point out on currencies, namely on the yen, which has steadily been strengthening. Again, not like exhibiting huge volatility, but has been strengthening nonetheless. If you notice, gold is now above $2,000. You can, in large part, thank the yen for that. And not only just JPY futures and gold futures being correlated, but yen, and the yen being the kind of directional driver of the two, for the most part. But gold pricing yen is now with a 3 handle. So there is, upside, of course, to, gold, but there is also that correlation with the yen that is still very much intact. And so gold traders who are looking at gold, you need to factor in what is happening with the yen and yen futures as well, directionally. And it looks like the European opium, as we speak right now, Eurostoxx banks are taking quite a beating, down 5.5%. Credit Suisse is down 60% at the open. UBS down 9%. Deutsche Bank down 8%, and so on and so forth. Okay, so this is kind of what I was just talking about. So looking ahead, Japan is on holiday tomorrow with markets closed. However, JPX, the Japan exchange, they launched holiday trading as of late last year, meaning that there will be continued trading in things like Nikkei and Topix index futures, as well as JGB futures tomorrow, despite cash markets being closed. And then, of course, we have the FOMC meeting ahead this week as well. And so all eyes will be on that and what Chair Powell and company will be doing in the face of all of this turmoil, as well as continued inflation to have to tackle and defeat. Okay, so that is it for me. Thank you for watching yet another episode of Market Depth. Make sure that you have your notifications turned on so that these episodes don't slip by, because they will be very time sensitive as to the price action for that particular day. And on behalf of Blockworks Macro, my name is Weston Nakamura. We'll see you next time. Thank you.